I'm Morella Fernandez. Thanks for joining us today on Market Call. Dennis De Silva on the show with us. He's Senior Portfolio Manager at Middlefield Limited. He'll take your questions on resource stocks. Here's how to reach us. 1-855-326-6266. If you would like to call in, you can send an email as well. marketcall@bnnbloomberg.ca. Dennis, thanks for joining us today. Good to see you.
Pleasure to join you, Morella.
Let's start by talking about gold, a shift by central banks to have more gold than U.S. Treasuries. I am wondering when the last time that happened.
It's been quite a while, actually, several decades since we've seen that experience. And, gold certainly has played a major role in shifts in reserve currencies. I think it surpassed the euro earlier this year, as well as obviously U.S. Treasuries. And obviously, it's a far cry from what people hold in terms of U.S. dollars. It would take almost a doubling before we reach that point. But needless to say, I think investors are looking closer and closer at gold, and more importantly for investors, gold equities as an alternative, in particular in 2025.
Okay, so what more does it signal to you? Has this just been more of a gradual pickup since the start of the year and tariffs were announced?
Well, let's keep in mind, gold has doubled over the last 3 years. So this has been a steady move over the last several years, and it's met with significant velocity in 2025. Gold's up about 48% year to date. And I think things really got kicked off when Russia invaded the Ukraine, and a lot of sovereign nations realized, no assets are safe. Your assets can be frozen, whether it's in U.S. dollars or otherwise, and that kind of started the ball rolling. I think you've met a fever pitch in 2025 from the fact that you have seen, obviously, geopolitical uncertainty in terms of what's going on in the Ukraine and Middle East, uncertainty around the Fed in the U.S., obviously, with President Trump trying to exert his influence. So there are a number of factors that have played a role, and some of it has to do with diminishing comfort around the U.S. dollar, retail demand for ETFs, Chinese insatiable demand at a retail level, and it's become easier to own gold ETFs and gold bullion in China. So I think the velocity and the momentum that we've seen for gold certainly could continue.
Also, this past week, two big changes at two gold miners. Can I get your take first on Barrick Mining and the CEO leaving there?
Yeah, kind of. I think it's a coincidence that you lost the CEOs for the two largest gold producers in the world at Newmont and Barrick. A lot of speculation going on about Mark Bristow, who took the helm with the merger with Randgold in 2018. So it's been 7 years. And he certainly had to navigate a pretty big ship in terms of cleaning up the asset base and deleveraging after that merger. It's kind of funny timing. It's similar to the Tech Anglo deal where it was odd timing on that transaction. In this case, you had Barrick starting to show momentum, a couple of good quarters of meeting and beating expectations. And then obviously the Nevada Complex tour that Mark actually hosted last week went extremely well. And you saw a good reaction in the market from that, with a number of analysts bumping their targets and looking for better things to come. So, although I think in the background, people were always speculating on succession at Barrick, and I think there had been conversations over the last several months, it was still odd timing with respect to some of the momentum we've recently seen with the company.
All right, we are going to take a break. We'll get some phone calls and some emails going for Dennis De Silva, Middlefield Limited. He's going to take your question today on resource stocks. Here's how to reach us. Back in a moment. Stay tuned. Welcome back. We are going to start with an email from Pat with a question for Dennis. Pat saying, what does your guest think about CNQ, Canadian Natural Resources? And I'm going to throw in sort of a caveat to that about oil prices in general, which are affecting the market. What do you think about CNQ, first of all, specifically?
Yeah, it's interesting, the second part of the question about oil, and among the seniors in Canada, CNQ is probably has the highest beta to oil changes because it is the least vertically integrated in Canada compared to, say, Imperial or Suncor and even Cenovus. It's certainly a well-owned senior. It has a top-notch quality management team, very strong free cash flow, and a solid balance sheet. And I think we've always considered them, top of class in terms of operating performance, great yield. But when you look at the stocks chart, it's kind of been flat over the last year. And when you look at it compared to, say, Imperial, it's like night and day in terms of performance. I think some of that has to do with a lack of differentiating catalysts with respect to, say, CNQ versus, say, Suncor, which was going through a re-rating and a rate of change and cultural change, or a Cenovus, which has, again, been going through a significant internal change to improve operations. This has just been kind of steady. And I think a lot of it just has to do with its oil price sensitivity, the fact that oil is in the low 60s. I think the lower oil prices also impacted its ability to hit some of its internal debt targets, which is impacting its ability to increase its share buybacks. So I think a combination of those things, some of them outside of their control with respect to oil prices being less vertically integrated, a little bit of a lack of catalysts, I think, I've seen it kind of stagnate more recently versus some of its peers.
Does CNQ tend to do a lot of buybacks?
Yeah, they've been very active, obviously very strong free cash flow, and they typically have used about 60% of their free cash flow to do buybacks. But I think the hope was once they kind of hit that $12 to $15 billion target on debt, they can increase the buybacks to 75% of free cash flow, which would be quite significant.
Okay, we hope that helps Pat out as we move on to Bob in Toronto with a question. Hi, Bob.
Hi, Morella. Thanks for taking my call. You sort of stole part of my thunder in Indians. Dennis, I'm just wondering what your thoughts are on Paramount Resources. And it's also similar to CNQ, flat and moving up, moving down, not doing nothing much. So I would appreciate your comments on that.
Okay, thank you for the question. Let's take a look at Paramount Resources right here, which is up just a little bit, but down over the last 3 years, about 22%. What has been going on with Paramount, Dennis?
Yeah, sort of a different story in terms of Paramount being more of a liquids-rich natural gas story rather than oil. Obviously, a smaller dividend than, say, CNQ. This is an intermediate gas producer. I call this the third version of Paramount after they sold their Montney assets to Ventiv. I think it was around 3.2 or 3.3 billion, and they paid a special dividend of about 2.2 billion. They basically also recently just sold off, I think it was just over half of their holdings of another oil and gas company called New Vista to raise some money to redeploy into their operations. I actually think they've shown very good operational momentum on what we consider very high impact assets, a very strong financial liquidity. I think they have about 800 million on the books after the share sale of New Vista. It is one of the highest growth companies with, I think, the current asset base probably going to double to about 60,000 BOE a day by the end of next year, 2026. And that's based on their strong Duvernay development plans. So it's a company that we do own in one of our portfolios. I think this just comes down to stronger gas prices at the end of the day, because it is one of the higher growth companies out there, solid balance sheet, certainly have the wherewithal to deliver on the growth, assuming gas prices cooperate. We've seen very weak Canadian gas prices, NYMEX. We certainly expect to improve going into the winter as LNG increasingly comes on and we start to export more, especially LNG Canada. They will be one of those beneficiaries.
Okay, Dennis, I hope that is good for Bob as we move on to Gordon in Victoria with a question. Hi, Gordon.
Good morning. Cardinal Energy is advancing its SAGD project at Reford to conclusion. All indications are positive. Could we see an improvement in the cash flow that would buttress the viability of the dividend and possibly re-rate the stock modestly?
Pulling up Cardinal Energy right now, it is at $7.78 today, down about 16% over the 3-year. So where is Cardinal Energy as far as growth goes? Is there growth for this company?
There certainly is growth, and I think it's not only, I mean, it's not necessarily driven by growth. It has a very high dividend yield. I think it's just under 9%. Questions about the sustainability of that yield in the context of low $60 oil prices. But I think the game changer for this medium oil producer is, as the caller suggested, it is the development of the SAGD, steam-assisted gravity drainage program, and it's about a 6,000 barrel a day program that will incrementally add to their existing base of 22,000. So quite important. And what's particularly interesting about this is it's modular. They can certainly add more of these once the first one is successful. So we call this kind of their thermal oil initiative. This has always been kind of a higher cost producer, so very high leverage to oil prices. And clearly they're not benefiting from oil being in the low 60s. It's going through this de-risking process as they prove out their SAGD project. And that will lead investors to think, okay, we could do this on a repeatable basis. It will obviously generate significant free cash flow, probably more than double their free cash flow, which allows them to delever and use those proceeds again to build the next 6,000 barrel a day project. So I like the scalability that they're kind of building into this. It's a little bit more longer dated, probably looking at late 26 for all the pieces to come together, but it pays people a nice yield. I'd say this is more of a retail held stock than anything else, but I think you might get more eyeballs as they develop their thermal process.
Okay, Gordon, I hope that helps you. We're going to take a quick break, lining up more phone calls for Dennis De Silva from Middlefield Limited. Back in a moment. Welcome back, and thanks for joining us on Market Call. Straight to the phone line. JC is on the line in North Bay in Ontario with a question, for Dennis. Hi, JC.
Hi, can I ask about Trican Well? It's done really well recently. Do you like this space of like the oil and gas services companies? And is there anything else you might prefer?
Okay, thank you for the question. We'll pull up Trican right now. It is moving up today at $6.33 is where I have it. Is this it's a services company, and I guess a broader question here about how well do the services companies do when the price of oil is down?
Yeah, it's an interesting question. And now this company is the only Canadian publicly traded pure play frac services provider. So it does lean towards the gas side, obviously, because of its frac services. It's actually not done too badly. I think it's up just under 30% over the last year. It certainly provides leverage to increases in Canadian drilling activity, without a doubt, and that drives higher margins. I think one of the key differentiators for this company, besides being unique in the frac services business, is it kind of offers these next generation low emission fleets. I think that certainly attracts a certain type of customer, usually the larger companies who want to lower fuel costs and carbon emissions. I think roughly 70% of their fleet is these low emission vehicles. So certainly high exposure to what I'll call next generation technology. It continues to benefit, I think, from its unique exposure to Canada's gas market. Obviously, with LNG Canada ramping up its phase one and potentially moving towards phase two, will be a key beneficiary of all those things. Quite a nice disciplined approach, low reinvestment needs in terms of CapEx, very strong free cash flow, in our opinion. I think makes it sort of a standout in the oil field services business. Stock, by our estimates, trading at a low multiple below its historic norm. And I think as the business stabilizes and we see stronger gas prices going into the winter and into 26, it will be a key beneficiary of that.
Okay, we should also add that it is hitting a record high today. So it's at 637 last time we had the chart up, which is a high for this company moving forward. Okay, let's get to another caller, or sorry, an email from Nancy. Nancy said, should I be selling Freeport? Can you tell me about Freeport, Dennis?
Yeah, Freeport obviously is a well-known U.S.-based copper, gold, molybdenum producer, one of the largest players in the world. It's top 10 for both copper and for gold, well known for its Grasberg mine in Indonesia, which is the second largest copper producer in the world and the largest copper mine if it was a standalone in the world. Unfortunately, more recently, a mudslide at the mine led to a couple of fatalities, and that led to the shutdown of the mine. It represents about 4% of copper supply globally, so obviously it has a major impact. Preliminary assessment is it probably won't get back to pre-incident levels till probably 2027, so it will have an impact. It tightens up what we already considered a tight copper market. Probably takes 1.5% out of the market in 2026 and possibly into 2027. And we've seen the reaction with copper prices. It's a unique company in that about 35% of its production comes from the U.S., and I think they represent about 70% of refined copper output from the U.S. So they're uniquely positioned for, obviously, the Trump administration's desire to see made in the U.S., sourced in the U.S., especially for a critical mineral like copper. So they kind of have this interesting positioning. Obviously got hit by the Grasberg incident, and obviously the revision to guidance. Obviously a side benefit is higher copper prices offset some of that. I know we've seen analyst revisions, some taking their estimates down, target prices down. Others, I think it was Bank of America, increased it because they thought the stock had fully reflected the uncertainty and risk associated with the Grasberg incident. It's a name we don't currently own. There are a couple others that we've preferred, like Teck or Capstone, to give us a little more leverage to copper.
All right, just for the viewers, it went down to $35.20 or so after that incident, down over the month about 15%, but beginning to bounce back from that right now. Okay, let's go to Bruce in Vancouver with a question. Hi, Bruce.
Hello. Thanks for taking my call. Dennis, I'd really like to get your opinion on B2 Gold. They finally got that mine going up in northern Canada and seem to have solved most of their problems. What do you think of the stock? Thank you very much.
Let's pull up a chart of B2 Gold and have a look at that. Dennis, go ahead.
I'll be honest, we don't currently own it. The caller was referring to actually a company that we used to own in one of our portfolios that they acquired Sabina, and they acquired the Goose River project in Nunavut, which, as he correctly said, is ramping up in the second half of this year. Like most mines globally, especially in Canada, took longer, cost more. It ended up, I think, costing them $1.5 billion to build. It is quite an important project because we anticipate it will generate about 300,000 ounces when it's at full steam in 2027. Unfortunately, a little bit behind schedule. We do see upside from expansion. This will obviously turn from a CapEx project to one where we'll see significant free cash flow come out. And that will be a nice contributor to their, what I would call peer leading dividend. I think it's just over 1.5%. It's done well. It's kind of underperformed the group, and I think that had to do with obviously the ramp up of this project, the cost overruns, the delays, nothing unusual. But I think the expansion potential of this project after the mine starts, and in particular, great outlook for some of their West Africa productions. It trades at about 20 to 30% discount to its peers. I think that will re-rate, especially when you consider the geopolitical diversification of being in Canada after being in the Philippines and Central America and West Africa. So I think this is one that can do well. A name on my radar screen, I'd probably look to add it once I see a little more steady state on the ramp up of Goose River.
Okay, Bruce, I hope that helps you. Let's go to Kurt in Scarborough, Ontario. Hi, Kurt.
Hi, Dennis. I'm calling to get your opinion today on Ivanhoe Mining and your long-term perspective on copper going forward. Thank you very much. Okay,
thank you for the question. Also, can you factor in, Dennis, if you don't mind, tariffs and whether you think that will affect the market?
Sure. I'll start with your question in terms of tariffs. We obviously saw the impact of the threat of tariffs from the U.S. government in terms of the movement of copper. And you saw a big differentiation in copper prices between what was the price in the USA versus London, because everybody was moving copper to try and get ahead of the tariffs. It really doesn't make any sense to me. I mean, it doesn't always have to be logical from an investor's perspective, but the U.S. is not a large player when it comes to copper supply. And from a resource perspective, never will be. Now, maybe they have a certain threshold they want to meet in terms of how much gets sourced within the U.S., and that objective probably could be met. But I don't think tariffs and the impact it has on other industries that use it as an input, that is copper, it would make sense from an industrial perspective. As far as Ivanhoe is concerned, unfortunately, similar to Freeport, they experienced a very significant event earlier this year that led to flooding and the suspension of one of their premier mines in the DRC. More recently, we saw a $500 million investment by the Qatar Investment Fund. I think that represents about 4% of the company. Certainly a vote of confidence after the company got hit hard after that incident. They're still recovering. They're trying to deflood the mine. They have 4 massive pumps that are pumping it out, at least the part that was damaged, I guess. Still trying to assess the infrastructure damage and how long it will take to reach or try to recover the mine. My guess is the mine probably won't be fully back to normal, if that's the right term, till late 2026. We were hoping to see free cash flow, an inflection point, at least in 2026. That could be pushed out. So it's a company that's kind of in limbo right now. It was going through a major expansion. I think that mine was going to grow 50% by the end of 2026 and become probably the 4th largest copper mine in the world, with very low capital or very low operating costs. Trades at a discount now, given the mine uncertainty and certainly the geopolitical risk of being in the DRC. I think this just highlights the scarcity of world-class mines. You know, the merger between Teck and Anglo highlights how tight the market is for copper. Nobody is building anything new that can add 2 or 3 or 4% to the world supply. And so you're seeing more and more M&A activity. I wouldn't be surprised if Ivanhoe is one of those takeouts for one of the bigger players who wants to get into copper in a more meaningful way.
Interesting. That's a long timeline for the mine that has been flooded, as you mentioned, for them to get back on track. Okay, we are going to take a quick break. When we come back, a look at Dennis's past picks. Back in a moment. Time now for a look at past picks from Dennis de Silva. These are from June 4th of this year. We will start with IM Gold on the TSX IAG. At the time, it was $10.17. It has moved up to $18.32, so an 80% upside here and a total return of 80% as well. This just caught the gold train, I guess, and kept going.
Yeah, without a doubt, it's caught the gold trend. But more importantly, probably at the time when I made it a pick, was they were going through the ramp up of their Côté mine, and that's a very significant mine for them after a very difficult, long process and expensive build. Like I said earlier, everything takes longer and costs more, and they're now going into this inflection point in 2026 where free cash flow becomes this wall of cash. It's going to be one of the top 5 Canadian mines when it's at full operation. I think this is still, as I probably said before, a takeover candidate because it has this critical mine of size. And I think with their Nelligan project, which could be similar in scope, you've got a company that could be 1 million ounces, or at least capable of 1 million ounces. That would be a great takeover target for a larger cap.
All right, let's move on to your next past pick, Spartan Delta, SDE on the TSX. So they do oil and gas exploration. At the time when you recommended it, it was $3.35. Now it's up to $5.40. So 61% upside, 61% total return. Tell me more about Spartan Delta. Is this something you still hold?
It is something we still hold, just like we still hold IM Gold and our other top pick. It's a gas and liquids producer, small cap, I would say. This is a company that's kind of rejigged itself, sold its assets a couple of years ago to become focused, spun out a company called Logan Energy, another name that we own and feel very good about. Kind of relatively under the radar screen, despite that return that you highlighted. It's going through kind of a transformational growth plan from what I like to call, boring, low growth, low inventory gas to a low debt, self-funded growth stock with a long runway and one of kind of the hottest plays with respect to Canada and lots of inventory and future production growth. So I see a very good runway for growth in this company. Despite the return, I still think it's underappreciated and we could see significant upside over the next several years, assuming somebody doesn't take it over by then.
Yeah, talking a lot about takeovers at this point of the show. Okay, let's go to your third pick from June of this year. Troilus Gold, TLG, on the TSX. At the time you recommended it, it was 64 cents. It's now $1.31, so 105% upside for return and total return. They also do exploration. Can you tell me a bit more about their operation?
Yeah, so this is I'll call it more a development company because they are moving towards financing, full permitting to build a mine in Quebec. This is a former producing mine. It's a large, long life, significant gold, copper, silver project. Whether they find a partner or not, which I think a lot of people are assuming could happen, we'll see. But they are at this critical stage right now of completing financing. I think they've had 4 letters of intent from export development agencies totaling $1.3 billion US. It's about $1.1 billion, $1.2 billion capex project to build this. It will be one of the top tier projects, I think, in Canada. Should be producing around 300,000 ounces when in production. Working on lending mandates right now, some offtakes, a lot of moving parts. Actually, we'll be meeting with the CEO next week to get a better update, but I think everything is pointing in the right direction. It still trades cheaply, in my opinion, despite the return that you've seen. It trades below average, I think, for development companies at this point. And there's still lots of upside in terms of the land base. So much focus on the existing asset. There's still a lot of regional exploration that could be tucked in and maybe made part of the project longer term.
Okay, we do have to wrap this block up. We're going to take a quick break. We'll line up some more phone calls and emails for Dennis De Silva, Middlefield Limited. He's taking your questions on resource stocks today. We're back in a moment. Welcome back to Market Call. Let's go to Michael on the line. He's in Vancouver today with a question. Hi, Michael.
Hi there. Thanks for taking my call. I'm wondering about Suncor. Is it a good investment? Is it the same Suncor promoted by Prime Minister Mark Carney? It turns into One FX Media once you send them $350, which I did, but I might be confusing with a different company. Is Suncor a good investment for senior to disabled people? Thank you.
Okay, thank you for the question. Let's pull up the Suncor chart. It's at just shy of $58 today, a little bit down on the day, but up 16% over the year. Dennis, what's going on with Suncor?
Well, Suncor, I think when we were talking about CNQ earlier, it certainly looks like it's standing still compared to Suncor's return over that same period. And this is a company that just gone through a very impressive turnaround under a new management team. This probably was precipitated by the activist investor Elliott, which got 4 seats. They developed a 3-year plan. We're about a year and a half through that plan. I would say they're probably ahead of schedule. They're probably at where they wanted to be after 2 years. They've kind of exceeded every single target they set. Really deep cultural change, I think, is very important to highlight under the new management team. This is a company where their break even, if you include the dividend, is probably moved into the mid $40 US a barrel level. while net debt is approximately half of where it was when they started down this 3-year process. So it's a very positive rate of change that's, I think, being reflected in the stock, beating companies like Cenovus and, more importantly, CNQ year to date and over the last year. And I'd say it's in line kind of with the energy index in general. They are returning 100% of free cash flow at this point through dividends, a combination of dividends and buybacks. It's a very well integrated model. As I highlighted earlier, CNQ is not as integrated as the other three. And I think that makes it more insulated from things like lower oil prices in the low 60s. Looking for some turnarounds on some of that infrastructure. And I think about half of their production is covered by their refining and upgrading capacity. It's a very solid business model. It's a name that we do own.
Okay, Michael, I hope that answers your questions about Suncor. Let's go to an email from Greg in Abbotsford, BC. He says, can I ask your guest's favorite institutional energy holding? So, Dennis, do you have a favorite?
Boy, it's so hard to pick among your children. I would say within our energy portfolio, one name that we just consider it so core is Topaz Energy. I know I've talked about it many other times. This was an IPO from Tourmaline back, I think it was in late 2020. And Tourmaline, by the way, still owns, I think, around 21% of the stock. This is a hybrid model. It's a royalty and infrastructure company, which is unique. Usually you're a royalty company or you're a midstream or infrastructure company. They're looking at acquisitions that will keep them differentiated. Their exposure is primarily to gas. I think it's around 70%. And I think that underscores the view we have of gas strengthening in 2026 for the next couple of years. Very nice income stream from both organic, their operations, as well as M&A. Very clean balance sheet. Some of the best operators in the Canadian oil patch, whether it's Tamarack, Whitecap, and obviously Tourmaline in North America. Right now, I think they're about 75% of their revenue comes from royalties. I think eventually they'd like to see more of their dividends supported from the infrastructure side, which is even steadier than the royalties. They're a little bit, I think they're at the midpoint of their payout ratio, which they target 60 to 80% of free cash flow. Very nice yield of, I think, around 5%. So I think there's a great combination of growth, lower volatility, unique exposure to the best plays and the best operators in the Canadian oil and gas patch. Certainly intertwined with Tourmaline's growth outlook on the gas side, and Tourmaline is the largest gas producer in Canada.
Okay, I hope that helps him out as we go to Hillary. Hillary's on the line in Saskatoon with a question. Hi, Hillary.
Hi there. Thanks for taking my call. Dennis, I've been a shareholder of MEG Energy since 2020, and I would like to stay a shareholder of MEG Energy, but apparently that's not one of my options. I've got the circular here on the Strathcona Resources takeover, and I'm just wondering if you can comment on the takeover and what it's going to be like being a Strathcona Resources shareholder going forward. Thanks for taking my call.
Okay, so this was the offer put forward by Strathcona, but then Cenovus actually has moved in. So can you shed a little bit more light on what's been going on there with MEG Energy?
Sure. And look, it comes down to Strathcona came in on a hostile basis, made an initial offer that was rejected by the board of MEG. Just for background, MEG is a heavy oil producer, just over 100,000 barrels a day of oil. Strathcona is also a heavy oil producer after it sold off its gas assets. Kind of the next day or the next week, they put in the offer for MEG. Strathcona, the issue is liquidity. It's institutionally held. Watrous and other institutions own it, so liquidity is an issue. Many cite asset quality concerns. I think it's not, my view is their assets are not as good as MEG's, or in this case, Cenovus's assets. The board of directors of MEG have recommended Cenovus's offer, even though on paper it is lower. There's a higher cash component. I think it maxes out at 75% of the offer is cash versus Strathcona's all stock. So for the typical shareholder, do I want to own a less liquid stock with questions about their asset quality, the ability to scale up versus Cenovus, top tier heavy oil producer, better synergies because they're in the Christina Lake region. So the assets are, almost commingled. So I think they could squeeze out better synergies from the existing assets as well as going forward with expansion. So for us, to be honest, we sold MEG because we saw limited upside. We already own Cenovus, so we don't need to wait around and get cash and Cenovus shares. So we didn't wait. We sold it in and around the offer that Cenovus made because I think it's trading slightly above that. And we'll continue to own our Cenovus and find the next play like the Topaz or the Tourmalines or continue to add to our Cenovus.
Hillary, I hope that helps you. We're going to take a break. Dennis De Silva is sticking around from Middlefield Limited. He's taking your questions on resource stocks. Back in a moment. Welcome back. Dennis De Silva is with us today as our guest. He's answering phone calls. We're going to Bob in Vancouver with his question. Hi, Bob.
Hello. Good morning. I would like to get his take on Whitecap Resources. I've held it for quite a while. It has a very good dividend, but my question is, do you like it or would you prefer something else in this space? Thanks for taking my call.
Okay. Whitecap, of course, did the Varen acquisition earlier in the year. It's up about 5.5% on the year, trading today at $10.65. What's your take on Whitecap for Bob? Would you go somewhere else with your money?
We do own Whitecap. As Bob mentioned, it has a nice yield, I think just over 6.5%. As you said, Marilla, the acquisition of Varen, kind of a game changer in terms of building this critical mass. It's about a 370,000 BOE a day producer, which was a double, focused in some very important plays in Canada, being principally the Montney and the Duvernay. This was a long anticipated merger given the operational overlap of their assets. And it really makes them one of the largest landholder of the Montney in Alberta and significant low decline production from its Saskatchewan light oil assets. So it's a nice mix in terms of good, stable, low decline production that generates free cash flow to finance the high growth gas assets. The market had lost confidence in Varen, so this was a necessary takeout. And I think Whitecap at this point with this critical mass is ready to start to ramp up and scale up the business after kind of going quiet through 23 and 24 after doing a number of acquisitions in 21 and 2022. I think the visibility over the next 5 years is to see this grow in that 3 to 5% per annum range to ultimately get, I think, in that 425 to 450,000 BOE a day range. It's kind of a company that tends to underpromise and overdeliver. I think it offers very good growth and a dividend yield that's above average for its peer group. Kind of that total return of 10 to 12%, I think, is quite attractive.
Okay, let's move on to Peter in Jackson's Point, Ontario, with a question. Hi, Peter.
Hi, hope you're enjoying the first day of October. Anyways, I have Kinross Gold. It's doubled. I'm just wondering if I should hold on to it or maybe move into another gold stock.
Okay, thank you for the question. A lot of people very focused on gold. It's done so well. So Kinross up 177% over the year. Dennis, is this one you'd hold on to?
It's a name I do own. This is one of the senior producers, kind of the best senior performer, I think, operationally, and probably even on a stock return perspective over the last 3 years. Still trades at probably a 10 to 15% discount to its peers. So I think there's re-rating upside and momentum to go from, this was a company that had high geopolitical risk when it had Russian assets and sold them in 2022. It's become more consistent with its operational beats, I'd say, over the last 2 years, consistently eliminated almost $2 billion of debt over that 2-year period, increasing return of capital to shareholders. At today's gold prices, it's almost hard to believe, free cash flow yield is top tier at over 10%, so double digits. Nice Q2 beat. I think the combination of strong free cash flow, return of capital, that probably is around 3% through dividends and buybacks. It's gone to become an 80% North America, South America focused company after selling the Russian assets. Great asset in Canada with their Great Bear acquisition. Looks like a 500,000 ounce producer when it becomes more late dated towards the end of this decade. I think they've got a little bit of work to do with that one. I think the market was a little bit underwhelmed by some of the economics they initially put out, but I think that will improve. So good leverage to gold. It's a name I continue to own.
Kinross is what we're talking about right now in Canada, but that's all the time we have for phone calls and emails. We'll be back with new picks from Dennis Silva in just a moment. Join us tomorrow on Market Call. Colin Szynski on the show. He's Chief Market Strategist at SIA Wealth Management. He'll take your questions on technical analysis. Time now for new top picks from Dennis Silva. We're going to start with Tamarack Valley, TVE on the TSX. What do you like about this oil producer?
Well, this is a great little company, similar to my last top pick, Spartan Delta. This is a company that I'll say 2024 was sort of their inflection point. We've seen now 6 consecutive quarters of beats, and in some cases raises. This is an intermediate oil producer that's been busy consolidating, in particular one of the hottest plays in Canada, the Clearwater heavy oil play. The most recent one being a $50 million, what I'll call a tuck-in acquisition in the second quarter. They've grown production by about 10% year over year on average up to Q2, and they're around 70,000 BOE a day in the second quarter. At the same time, been able to reduce their net debt and share count by, I think it's 17% and 6% respectively. We're looking for a little more moderate growth, especially with oil in the low 60s. You're looking at a CAGR, probably 3 to 5% over the next 5 years. That could obviously ramp up with higher oil prices. Very high efficiency wells, strong free cash flow. I think their capital efficiencies have improved, very good netbacks again. And this Clearwater, again, one of the hottest plays in Canada, and they're one of the bigger players. I think the break even is in the low 40s US per barrel. About half their production is in this Clearwater. And I think one of the highest torques that you'll see, the falling differentials, especially given TMX is online, and what that can mean if there's even higher oil prices. I think they return about 60% of their capital to shareholders through the dividend and buybacks. So it's a name we really think will do well, especially if you think oil is kind of in this trough and you could see upside over the next year.
Okay, let's get to Sitka Gold, which is a gold mining services company, SIG on the TSX. Can you explain a little bit more about what they do and what you like about them?
Sure, I'll actually just make a correction. As ticker symbol is SIC, and it's
thank you.
A gold explorer, very large land package. My next 2 picks are kind of what I'll call my Yukon gems. Gold has done extremely well. Gold equities have done extremely well. All the seniors, I think, have re-rated over the last year after lagging for a couple of years. This is a company in the Yukon. The Yukon suffered a bit of an image issue with Victoria Gold's Eagle Mine heap leach contamination failure in the mid 2024 and the subsequent bankruptcy of that company. I think things are starting to turn around. This is a company with just under 3 million ounce resource, a very large drilling program in 2025 that will look for a combination of new discoveries and going deeper into their existing resource. So I think turn this into a plus 5 million ounce project. You look at Snowline Gold, kind of a carbon copy in terms of expectation. That's 9 million ounces. The valuation certainly suggests the market expects more than 5 million ounces and potentially higher grade deposits being formulated. This is, in our opinion, a multi-deposit project with district scale potential, very well financed. I think they had $15 million last time I talked to Cord, the CEO. So it's a great name in the Yukon.
Okay, we are almost out of time. Let's get quickly to White Gold, WGO on the TSX. In about 30 seconds, Dennis, can you tell me what you'd like?
We've been involved with this company since 2018, really has turned the corner. Small cap gold exploration company with 3 million ounce resource in the Yukon. Similar company next door just did an acquisition from Newmont, and it's trading at 3 times the valuation. So it kind of gives you an idea of what I think the stock could do. Interesting neighbors like Newmont, Agnico Eagle. Pierre Lassonde is a shareholder in that new co. Agnico Eagle owns just under 20%. I think the timing couldn't be better. A new VP exploration is involved, and he discovered Great Bear as part of that team. So revaluation of the asset base, a ramp up in activity, I think could really significantly increase the resource and make this a takeover candidate.
All right, we do have to leave it there. Dennis De Silva, sir, thanks for joining us today. Appreciate your time. And thank you for joining us today on Market Call. We'll see you again tomorrow.